Let's move to the final topic, valuation. Valuation is the foundation of value investing. If you don't know how to calculate the intrinsic value of a business, how can you buy an undervalued business and keep enough margin of safety? Real estate investment is the same logic. You need to find an undervalued property, do some renovation and rent it out. If you buy an inflated property, you could lose it during a bear market. There are primarily two valuation methods, based on assets or based on income. There are no fixed rules for valuation. Each value investor could be different. Various non-financial factors should also be considered, like the brand, management quality, client satisfaction, etc. But Warren Buffett says, "I would rather be vaguely right than precisely wrong." The valuation based on assets is easier to understand. It's either liquidation value or reproduction costs. Liquidation value means you sell the assets at the current market price. Reproduction costs mean the amount a competitor has to pay to replace them today. Sometimes, there may not be liquid market to sell those assets. You may also need some insight knowledge to estimate the reproduction costs. There are some simple guidelines to estimate the value. For cash and marketable securities, you can use 100% of the value in the balance sheet. For accounts receivable, you only count for 85% of the value. For inventories, it's even lower at 50% of the value. For property, plant, and equipment, 45% of the net costs is the max. For goodwill, 0% should be used. It means that there is no value for goodwill in liquidation. Reproduction cost is usually used during a merger. You want to acquire a company, so you need to calculate how much you need to pay to buy the assets elsewhere. In this case, goodwill could worth something, like the value of the brand, consumer loyalty, and distribution networks, etc. Benjamin Graham's popular net-net method is famous for using the liquidation value to purchase undervalued stocks. Those are usually not good companies, but when you sell the whole assets, you can still get more money back based on current stock price. For example, the market valuation of a company is $100 million, but the assets liquidation value worth $200 million and the liabilities are $50 million. If you buy the stock now and wait for its liquidation, you can get about 50% gain. It doesn't make sense, but it exists during extreme market situations. The other valuation method is based on income. The most popular valuation model is the discounted free cash flow model. Firstly, you need to understand an important concept, the time value of money. The time value of money means that a sum of money is worth more now than the same sum of money in the future. Firstly, the money can grow only through investing, so a delayed investment is a lost opportunity. Secondly, inflation has a negative impact on the time value of money because your purchasing power decreases as prices rise. Thirdly, there is always a cost for the money. When you borrow money from the bank, you have to pay interest. There is a formula that best describes the time value of money. FV is the future value, PV is the present value. I is the interest rate, N is the number of compounding period per year, and T is the number of years. How to best think about it? Interest rate is what the bank will pay you when you deposit money, so it's the risk-free return that you can get from your money. When the market decides the interest rate, it will consider economy, inflation, and opportunity costs, etc. So, interest rate is usually considered the best representation of the cost of money. During hyperinflation period, you can also use inflation rate to calculate the time value of money. Let's have an example. Assume you have $1 million at present. If you can invest the money in a project, and the annual return is 10%, so how much you will get after 20 years? The future value will be 1 million times 1.1 to the power of 20. The result will be $6.7 million after 20 years. So how much $6.7 million worths at current price? Assume the interest rate and inflation rate are both 3%. The present value will be 6.7 million divided by 1.03 to the power of 20. The result will be $3.7 million. You can see that after 20 years, your money could depreciate about 50% of the value. That's why you have to invest your money to fight against inflation. If you can understand the time value of money, here is another concept, annuity. Recurring payments, such as the rent on an apartment or interest on a bond, are sometimes referred to as annuities. In ordinary annuities, payments are made at the end of each period. With annuities due, they're made at the beginning of the period. Here is a formula to calculate the future value of ordinary annuity. FV is the future value. C is the cash flow for each period. I is interest rate, and N is the number of payments. Let's have an example. Assume you want to invest your money in the S&P 500 index. You invest $5,000 per year at the end of each year when you get bonus. So how much you will get after 30 years? The S&P 500 index has returned a historic annualized average return of around 10% since its 1957 inception through the end of 2022. The future value will be $822,470. But how much have you paid? Only $150,000. The return is pretty good. Now you can see the power of the compound interest and index investing. Once you can understand the related concepts about the time value of money, we can discuss about how to do the valuation for a stock or a property. Discounted cash flow analysis helps to determine the value of an investment based on its future cash flows. Here is the formula. The present value of expected future cash flows is arrived at by using a projected discount rate. This discount rate is usually the risk-free rate, or the interest rate, plus some risk premium depending on the industry and business. You need to estimate all the cash flow that can be generated throughout the lifetime. For real estate investment, it's much easier to understand. You rent out your house and get rental income, deduct some necessary expenses, then the cash flow can be calculated. You can assume the rent increase is 3% per year, and your expenses also increase 3% per year. Then, you can use the formula to calculate the present value of the house. Since you could collect the rent forever if you like, it's called perpetuity. The formula to calculate perpetuity is cash flow divided by interest rate. Assume your net cash flow per year is $20,000, and the interest rate is 3%. The value of your property will be $20,000 divided by 3%, which is $666,666. In order to make valuation for a stock, you need to estimate the free cash flow in the future, then use a discount rate to calculate the present value. This is not easy, and many security analysts can calculate quite different value for the same stock. However, for a stellar company with stable business and cash flows, it will be much easier. We can use the perpetuity formula to estimate the intrinsic value. You can just use the adjusted earnings or free cash flow, divided by a discount rate, like the risk-free rate plus risk premium, or the cost of the capital of the company. For example, Apple stock's annual free cash flow for 2023 was about $100 billion. Assume the discount rate is 5%, then Apple's market cap should worth $100 billion divided by 5%, which is about $2 trillion. Many may think that Apple company can still grow, so the cash flow in the future should grow as well. We can use the growing perpetuity formula. The formula to calculate growing perpetuity is cash flow divided by the difference of interest rate and growth rate. Assume Apple company can still grow at rate of 2%, then the intrinsic value becomes $100 billion divided by 3%, which is about $3.3 trillion. Many people have different ways to evaluate the same stock, but if you would rather be vaguely right than precisely wrong. If you invest in a high-quality company, with excellent management team, and you buy at the right time, with enough margin of safety, making money will be much more easier and reliable. Now you understand all the important concepts in accounting, finance, and valuation, which is critical to your investment success. Thanks for watching.